Hello and welcome everyone to our second annual State of the Commercial Real Estate Market webinar. We have an excellent panel of experts who bring with them a different perspective, given their property type focus, investment thesis, and function. We will discuss the current state of the market across a variety of property types and get the views of each panelist. We have a few polling questions that we'll work through to get a flavor for our view on the market, or your view on the market, an idea of who is in the audience. We will share the polling results as we go. First, I'd like to turn it over to Jonathan to introduce himself.
Hello, everybody. I'm Jonathan Chasson. I'm the Chief Financial Officer of Brixton Capital. Brixton Capital is focused in commercial real estate, shopping centers, as well as multifamily. And I've been involved in those two areas for over 20 years.
Frank?
Good afternoon. My name is Frank Saracino. I'm the Executive Vice President and Chief Financial Officer of BrightSpire Capital. BrightSpire Capital is a mortgage REIT that targets loan sizes around $30 to $50 million, internalized in 2021 out of Colony Capital, and I've been with the company since that time.
And Eric?
Hi, everybody. Eric Batis. I'm EVP of Operations with Ashford, Inc. Ashford, Inc. is an asset manager and advisor to three public hospitality REITs. That's Ashford Hospitality Trust, Braemar Hotels and Resorts, and Sterling Hotels and Resorts. I run our asset management division as well as our group of companies that provide service to the hotel industry. So we're primarily hospitality focused, and I've been with the company for about 10 years.
All right, awesome. Thank you all for joining to spend some time with us today and sharing your views. And first, just to get started, the Fed last week released their indication for the rates that they're going to keep them steady for the foreseeable future. They'll reduce their rate decreases from multiple times this year down to one, widely expected to be later this year. So in light of that, just wanted to go around the panelists to get their views on kind of what the next 6 months or the balance of the year looks for in your sector. And then maybe Eric, will start with you.
Sure. So, we throw into all of that there's an election coming, and I think there's a lot of uncertainty of what's going to happen over the next 6 months, and a lot of people waiting to see what will happen. I'm of the hope, maybe, and maybe it's naive of me, that this latest news from the Fed is simply trying to, over the next month or two, get similar inflation numbers or flattening numbers to what we showed in May. And if that happens, we could end up with a surprise cut sometime before the fall, and then another one in December still. But certainly the numbers are progressing the way that we want them to from an inflation perspective, and we're seeing that in a number of indicators in our business. And I think they're really just trying to put the last nail in the coffin, if you will, of ensuring that we get back to normal before making any cuts, and that it's better to trail than to be the leader in this. So that's kind of the prevailing view on our side.
And Frank?
I echo some of that. I'm a little less positive or bearish, mainly due to the election. I think the Fed's recent announcement is kind of saying that they're being open-minded. They're going to evaluate information. Hopefully that leads to everything kind of stays steady, and that we get a cut in the fall. Does that mean we get two? I think the election, Tara, what Eric said, is just such an uncertainty. And whether that leads to another one before the end of the year. But, I feel like we'll get one, whether it's in the spring or in the fall, right after the summer, or, one after the election.
Certainly. And Jonathan, any thoughts to add?
Yeah, look, I think, everyone started the year thinking there could be upwards of 6 interest rate cuts. Obviously, at this point of the year, the thought is maybe there'll be one, maybe two at best. I think the issue for in the commercial real estate is going to be there's a lot of people were hoping and were counting on these rate cuts to happen much earlier, and I'm not sure how much rope they have with regards to especially multifamily if you have floating rate debt, and how sensitive interest rates are to the cash flow of those assets, or the negative cash flow that some of these multifamily projects have today.
That's a great transition into the next kind of topic I wanted to talk about, where the mortgages and real estate loans that are coming due here, in the next year or so. CoStar had an article this morning talking about how CMBS refinancing were actually came in better than expected in May. So just wanted to see, are you guys seeing any opportunities? Is there threats out there? And just maybe get your view on that. Jonathan, maybe we'll start with you on that.
Well, we've been, and I see it differently. Like we have, in multifamily, a lot of the debt is coming in through the agencies for Freddie Mac and Fannie Mae. So a lot of people really aren't using the CMBS market for multifamily. But there are quite a few loans out there that are floating rate based. Mm-hmm. And there is definitely, cash flows have come down dramatically. So there's a lot of struggling multifamily investors, especially people who bought in, let's say, 2021 or early parts of 2022. And they've had, if they're with floating rate loans, their interest rate expense have gone up a lot. So we're kind of expecting to see some stress in the market. We've been kind of waiting for a while. And now with, the amount of interest rate cuts are going to be much fewer and slower, we think there may be people who are going to have to sell.
And it feels like the longer the delay is on the interest rate cuts, the more people will get captured in that net of needing to refinance.
Yes. And in many cases, these refinances are cash-in refinances. So there's lots of refinances where people are going to have to put money in to get a new loan.
Right. And then, Frank, I think you guys have an interesting perspective on this. So I'd love to get your thoughts here.
Well, I mean, our kind of view is that, everything coming to maturity or final maturities, or where the banks have just had enough now, is going to force the activity. Right. I think some banks, talk about us as well. We're willing to work with certain lenders, certain borrowers who are showing real commitment to the property, the ability to operate the property. And then there's some where, that's it. We've had enough. So it's forcing them to go to the market, and maybe, we're going to have to accept a DPO or some type of short sale. And I think this is going to resonate through the market. And, and I think for a buyer, when they see the debt at the table, besides the actual owner of the property, they know this is serious and they can bid, and this is likely going to get sold. But this is going to put, the pressure on valuations, which I think is something we're going to talk about later. But we kind of see this inevitably happening, and this is going to foster more acquisitions and just more activity in the market, but really not, towards the second half of the year.
Makes sense. And then, Eric, I know, you guys have been in the news with some of this activity. So also, what are your thoughts?
Yeah, it's tough. We're seeing lenders, kind of like what Frank mentioned, with a lot less flexibility than maybe they've had over the last few years, with folks that were willing to give extensions or make accommodations for a number of years. And now that's kind of gone away since COVID. Not gone away completely, but certainly a lot less flexibility. And it makes a tough environment. We've got increasing revenues, but revenues that are increasing 2 to 3% when inflation's higher than that. So with NOI, in some cases, backing up or flat or low growth, the debt yields are not as high as they need to be. So this cash out of pocket is absolutely something that we're experiencing. So we had a series of givebacks last year, but what's interesting is, we're still managing through some of those situations because no one really wants to immediately take these yet. And it's not necessarily a market where selling is going to get the return that you want as a lender. At least it seems that way for us. So until we see how, some of the transaction activity normalizing, the other factor in all this is CapEx that we have coming due is another element of us having to make decisions with refinancing assets. We either renovate these assets that we haven't renovated for 4, 5, 6 years that have brand standards with Marriott and Hilton, or give or refinance the debt. And in some cases, you got to do both of those things. So it makes it very complicated in hospitality, particularly where we're very CapEx heavy. So we feel like right now at this point in time, we're seeing kind of 2 or 3 decisions that we've got to make since COVID that are kind of piling up on us in some ways. So it's tough. Maybe my optimism about the interest rates is more of a wish than anything else.
Well, I think many of us are like-minded in that respect. Yeah. So moving along, Frank, I think it'd be interesting for you to comment on alternative sources of capital and how maybe the current market situation has generated those opportunities for these alternative capital sources.
I think it's, simply a lot of the banks, have announced they're going to maybe sit this one out in the next round of real estate, as well as are pushing to sell. There's been this is not a secret. There's been a ton of private debt or private funds raised that are kind of just, waiting on the sidelines to jump into credit and really get this money deployed. And I think that, like I mentioned, second half of the year, we expect to see more of this activity, due to the banks, again, finally putting it to their borrowers, it's time to sell. And that's going to be a good opportunity for these private funds as well as for the mortgage REITs to pick up a lot of this credit.
And I was in New York not too long ago, and it felt like obviously mortgage REITs, but also private equity was pushing into credit. So there's a lot of credit available through private equity firms.
That's right.
So there is a lot of capital out there ready to step in as either a lender or even on the equity side, which kind of brings us full circle on, is this buy sell gap that we've had for some time now, do we feel like it's closing, and kind of where are we headed? So Jonathan, maybe we'll toss it to you and get your thoughts on if the buy sell gap is closing.
When I started the year, I thought the buy sell gap was going to be closing much quicker than it has. So we're very opportunistic. We're constantly looking. We have a pretty large acquisitions team, so are very transactionally based, and it's still really tough to find deals. There's still a disconnect between what the seller thinks their asset is worth and what most buyers are looking to transact at. So there's a lot of product that's kind of on the market, and much fewer product is actually being sold. I think that's probably the biggest in multifamily, which is the most sensitive to interest rate movements from what I've seen. I think retail, probably the buy sell isn't as high, but multifamily, it's still pretty tight, pretty wide gap, I think.
It's interesting. And Frank, I don't know if you have a view on that, but I imagine you. But
yeah, I mean, look, as I said, as lenders are forcing the borrowers into these positions that they have to sell or have to move the asset and they can't refinance it, or they're going to refinance it at a lower valuation, it's going to force the activity, for John and for his type of company. So, we see that coming to the second half of the year. But this comment won't shock anyone, but if the Fed would give 25 basis points in September, I feel like, just people are going to go crazy. So I think that'll be the spark. But if that delays, you could see this carry on a little bit longer. But I don't think that there's necessarily certainty that even at these deals, at least in today's, John, I don't know what you think in the kind of current environment today, even if there are transactions being talked about, there's no certainty that they're going to close. Hopefully that in the second half of the year, we just see more certainty around that.
Yeah, but one of the big things I see is there's lots of talk of the rates coming down, but those are short-term rates. So everyone's talking about like the Fed funds dropping, or maybe SOFR, some of the short-term rates. Long-term rates, and that's typically how we're buying real estate. We're more focused on the 5-year Treasury. Granted, we are looking at short-term rates, but the 5-year Treasury is really, or even the 10-year Treasury, and those rates are not really looking to be coming down, or if they come down, it's very muted. Like you're talking, so it's an interesting dilemma because short-term rates are going to come down a lot probably over the next 18 months. Long-term rates, not really.
Yeah, that's interesting. Eric, thoughts on the buy-sell gap?
No, I think a lot of what these guys are saying are things that we're experiencing as we're in the market trying to sell assets, and not to jump to certainty, I suppose, with what Frank mentioned. We're actually experiencing a lot of buyers who seem to be shocked at the cost of debt that they're getting as we get closer through diligence, and obviously disappointing as a seller for someone to get to that stage and not know what they're going to be able to get done. But I think there's a lot of hope that people are kind of getting into deals, tying things up, trying to close that gap, and expecting maybe they'll be able to close it through their cost of capital, and it's just not happening. So that certainty's lower than sellers would like.
And deal size too, right? It feels like lenders have reduced their deal size or appetite for the larger deals, and then you take out some of the large money banks. It gets difficult to get a deal done if you don't have those pre-existing relationships. And then just Eric, you had touched a little bit on compressing margins on your NOI. Maybe add some color on where you're seeing that pressure. I know our clients are seeing a lot of year-over-year insurance cost increases that are hard to underwrite.
Yep.
So would welcome your thoughts.
Yeah, we've had some deals fall out with cost of insurance, and we've got a large portfolio of over 100 hotels, and we end up obviously having pricing that some other buyers can't replicate in some cases. We actually just got our property renewal done for next year, and we're able to experience a reduction in cost, which we're thrilled about. So excited about that actually starting to move the right direction. But we're fighting a lot of that. Most of our margin pressure is coming from labor, right? A lot of people in hospitality, we've got wage rates that are up 40 to 45% from 2019, and certainly our revenues are not outpacing that. But most of that increase was through Q4 of 23, and we've kind of seen it start to flatten off, and certainly recently maybe return to a normalized 2, 3, 4, 5% increase there. So we're having to fight with productivity and trying to increase our productivity of our associates, and our labor hours are down 15% from 2019 as a result of us trying to combat some of those pressures. But that pressure is kind of coming from everywhere. But we're having to get very aggressive on the way that we generate revenue too. Hospitality is a unique vertical in the commercial real estate space. We have 24-hour leases, right? So we have the ability to change the mix of business in our hotel from group business to transient business, and we've had to focus on that quite a bit as well as we fight some of those margin pressures.
Mm-hmm. Yeah, it makes sense.
Brett, I was just going to add to that, just to the insurance. I mean, we're seeing that kind of across the board. I think there was an article in the Journal this morning, regarding Florida and other places, depending on where properties are located. But this is going to meaningfully eat into NOI, which then, of course, puts challenges around covering debt service.
We saw situations where in the last couple of years where buyers were not able to get insurance. Not just that insurance was increasing, that they couldn't get it. And so that's at least seems to be improving a bit, but it's that has absolutely affected transaction volume. And I mentioned CapEx earlier. All those things are really weighing into it.
And Jonathan, margin compression, have you guys seen that?
Like it really, and I think it does depend on the asset class a little, because I'm not sure about the hotels, but definitely in multifamily, a lot of insurance companies don't like the multifamily space because people are living in the assets all day long. So definitely property risk is higher. What we've seen is that there were really two pieces that really impacted insurance. One was replacement costs. So for many years, the insurers didn't really focus so highly on replacement costs. And what they saw over the last 2 years was that replacement costs, especially in these master policies where you're grouping a lot of assets, were significantly below what it really costs to replace an asset if it burnt down. So there was a lot of pressure by like pretty much all the insurance companies I've talked to of increasing the replacement cost dramatically. And that could have been a 20 to 40% increase just in the replacement cost. In addition to that, they also started increasing the rates. So you may have had increases on replacement costs and rates, and you could have had rates going up 40, 50, or even more. It could even doubled in one year. I think we're actually starting to see a bit of a softening in the insurance market for at least for multifamily, where we just did a large renewal, and we saw that actually rates actually came down between 2 and 10% on property. So that was at least a good sign that maybe rates are kind of for multifamily on the way down a little bit. And part of it is, capital markets play a big part in insurance as well, with the reinsurance markets, etc. So, so things hopefully are turning the corner. I'm not sure how much insurance will come down, but we have seen some reductions in this year.
A reprieve is always welcome. Transitioning maybe to a topic near and dear to my heart is valuations. So maybe just generally, let's talk cap rates, and if you want to take it maybe by your sector, and where you see cap rates going, maybe just over the next 6 to 12 months. So Eric, maybe we'll start with you and put you in a hot seat. Where do you think cap rates are going?
Yeah, I guess it depends what camp you're in on favorable, neutral, or unfavorable, right? Our cost of capital is going to influence cap rates, and our ability to work the cap rates up or down is a little bit better in hospitality because we have these short-term leases and can be nimble with profitability. But we're so focused. The cap rates are so tied to cost of capital that it's, I think that's why we're kind of seeing stagnation in some ways, because people are waiting to see what direction things are going to go. I tend to believe we've certainly seen an increase in cap rates recently within hospitality due to some of that uncertainty and the cost of capital remaining up. But I think as soon as we see a reduction in rates, in interest rates, we're going to see valuations skyrocket, and we'll see. We trying to time that up has been something I think a lot of folks have been doing for the last year or so, and that shows how long this has kind of gone on. So TBD based on who's right in the polling results.
Yeah, the most anticipated recession has yet to hit, right? And a lot of capital out there waiting to move. So Frank, thoughts on cap rate movements?
Yeah, our main sector is multifamily, and I'm sure John will also have a view on this. We think that kind of cap rates are probably at the top now, as to where they are, 6.5%, depending on, the asset. If we're seeing things where there's actually upside, where there's vacancy and rents can be pushed, that could fall, lower into the 5s. But we don't really see cap rates on multifamily coming down much, because it's still, probably the most popular asset class, but it's probably kind of steady. Doesn't really go up. If it does go up, it won't be much from here. I'm sure John's got a view on that.
Yeah, I guess I'm not thinking cap rates are going up either. Like, I think we're thinking maybe they're going to be neutral. Maybe they can go down a little bit. Most of the stuff we're buying, and we're more in the western states, is more in like the 5.5 range. The hard part to factor in is there is so much money sitting on the sidelines, and you have all this institutional money just waiting to pounce. How will that actually play out? Like, when will they come in? Because I don't really see a lot of reasons why cap rates should be coming down a lot. Seeing where the 5-year treasury, it's going to be pretty flat for a prolonged period of time. So, but there is all this money that at some point is going to want to get placed. Our typical underwriting right now is we're kind of pretty much underwriting like flat cap rates.
And then that makes sense. And then what about opportunities? Where do you guys see opportunities in the market? And Frank, we'll start with you. where you guys think that there might be some?
We're not seeing a ton of activity right now. In the market, there is some, kind of post-construction multi that the banks are pushing out, that's moving on, but we're just not. We're starting to really just start to see the signs of kind of what we discussed earlier on, the lenders really putting pressure on borrowers and property owners to take these things to market. So, we're kind of seeing, it's kind of slow out there right now, and just, but seeing signs for where it can really pop into the second half of the year.
Makes sense, Eric.
Yeah, I mean, when we look at it, construction starts in hospitality are basically zero, and so new supply coming into the market over the next several years is going to be very low. And so the opportunity is, it's similar to what Frank is saying. Everything's kind of waiting, but if we get through this stage of the economy where the transaction volume and this gap between buy sell, we can get beyond that. There's a ton of opportunity in 2, 3, 4 years of owning hotels with very, very little supply growth, and for revenues to start to really jump. And so it's timing all of that, all these different things that go into valuation, how much CapEx you're going to have to spend, and how much you're going to be able to lift revenues in any given market based on demand. So those highly increasing CapEx costs and development costs are putting a lot of folks on the sideline, and that level of supply is just going to be gone for the next few years. You can't just pop up a new hotel in 6 months. So finding those right markets and identifying, hotels that have a little bit of runway is something we're trying to do for the portfolios where we are doing some acquisitions. And I think that supply demand is going to be very interesting over the next 3-4 years, particularly in our industry.
Makes sense. And Jonathan, where are you guys? Yeah.
Well, like on multifamily, I think we're looking at areas that, there's a lot of big areas like the Dallas, Austin, we're in Texas a lot, and, Phoenix, that have so much supply coming in that rents are being depressed, or they're having like 1 to 2 months of concessions. So, but what we're thinking is, if you haven't started building multifamily, if you didn't start construction in like 2021 or maybe early 2022, you aren't building. No new projects are starting right now and have not started in all of 2023. So we think there will be a lull in the market of new, all of this new product is going to get absorbed probably within the next, 12 to 18 months. And once that gets absorbed, we think that in some of those markets that are right now struggling, there will be a lot of pent-up demand, and rents will increase more than the typical 2 or 3%. Because, globally, within the United States, there's still a 4 to 5 million unit housing shortfall. And that's been, the question is, where is the shortfall? It's all across the U.S. So we have a huge housing shortage here. And, right now there's too much new supply coming in, but there's still a lot of demand. And once that supply of new product is, absorbed, we think there will be some good rental increases that will happen. And so we're looking at a lot of newer product, could be brand new product coming right out of the merchant builders who, we're struggling right now with, negative cash flows, or their lender wants, the loan to be paid back, those types of circumstances, because we think, later on, and then you don't also have the CapEx issues and, buying like an older product. But it's still tough. Everyone's still holding tight as much as they can for hoping things get better.
And I think one thing that plays in there, and this is probably more longer term, is there's so much talk about office properties being converted to residential properties. It's not easy. There's zoning, there's construction costs, CapEx, everything you have to do with that. But that is probably not a 2025 problem. But probably if those are successful, what does that mean for the longer term? But hopefully by 2025, current people who need to sell do sell. Some of that capital sitting on the sidelines is deployed, and we kind of see where this is once some of these buildings get converted.
Yeah, and it depends where these office buildings are too. But
Agreed.
we've looked at a bunch of office to see if they had any way of converting. The problem is a lot of the dimensions of office buildings are so different than how you would build a multifamily project. There's a lot of like dark space. You can have, offices, there's lots of interior offices and things like that. They don't really work that well for multi. And maybe, look at maybe people's habits or expectations will change. But there are some office that's getting converted. I've seen more hotels being converted to multifamily. I think there's areas where hotels aren't doing that well, and I think that's a much easier conversion versus office conversions.
Yeah, I would agree with that. We've seen some of that as well, and we've looked at some development projects for office conversions, and you just need so much plumbing for both multifamily and hospitality in each individual unit that it's cost prohibitive, especially with where costs have gone. It's very expensive to even consider some of that. So everybody's thought that some of those depressed offices would present great opportunities, but these adaptive reuse projects are harder to get executed than maybe they have been previously.
And part of that formula is the value of the structure as it exists, right? And so that still has to come down before it really starts to make financial sense. And then we'll just continue the conversation. So I guess in terms of staying on opportunities, we talked about the buy-sell gap. It feels to me that I kind of picture like a marathon race with the guy standing there with the gun, and as soon as the Fed, decreases the rates by 25 bips, like that's going to be the gun, and people are going to start running right for their first deal or series of deals. So what is the likelihood that that's in the fall versus towards the end of the year? And I know we kind of covered this a little bit, but I just feel like it's not going to happen before the election. So real quick, before or after, Eric?
I go after. And I think that that's part of what the Fed's trying to do here, with, even though we're seeing things coming down, inflation normalizing a bit, you don't want housing and other costs that factor in to balloon immediately. And with institutional investment in single family residential, it starts to become a bigger problem if it happens too fast. So hope before, likely after, given latest.
Well, and that brings up a good point. If a single family market, the rates, the mortgage rates, I saw they ticked down last week slightly. They've been under the 30-year mortgage has been under 7% now for a couple of weeks. So that's a downward trend, which is good. But still, home affordability is really, really low. And by the last 20 years, it's at an all-time low, which obviously has an impact on multifamily. But if you do drop the rates, right, like I could see housing prices escalating, which just kind of compound the issue. So Frank, I'll throw it to you, before or after. I think I know your answer, but
I hear points on everything. I'm also concerned that if something happens before, or is one side of the political camp going to yell, if it doesn't happen, what's the other political side? And the Fed's in an inevitable position that no matter what they do, somebody's going to say that they're favoring one side or the other. But ask me again tomorrow. I go back and forth between before and after.
I feel like I hear that both political sides are yelling constantly, right?
Yeah. So, it's probably safer that they do nothing and just kind of then, fall, and then post-election. But then it's December, it's Christmas time. Everyone's going to check out, and then it's, you're into, the early part of 2025. And any transactions obviously take a couple months to get done anyhow. So, that just further delays, in my opinion.
Yeah, it makes sense. Jonathan?
Yeah, I think there's probably more people saying let's just wait until the outcome of the election. Just buying into a more uncertainty. So probably more people are waiting. But at the end of the day, I don't see long-term rates dropping that anytime soon. So talk about like a 7% mortgage. Sure, could it go down like 50 basis points, something like that? Maybe, but I think there's a lot of people who are locked into like 3% mortgages, or even 3.5. Like the time for those types of mortgages, I think it's very, I don't see, unless there was a geopolitical event happening or something crazy out of the norm, I don't see how rates ever come back down to that. But inflation, has always been good for real estate. So, I think that's probably more, people just concerned that housing prices are going to go up, is having more people saying I should buy now, or if I wait too long, I'll never be able to afford a house. I think historically, if you look over a long period of time, 40, 50 years, a 6 or 7% interest rate on a mortgage was probably the norm. So it really depends on what you kind of compare, what is the right, equilibrium, or where you think is kind of, all things being equal, where should mortgage rates typically be? If I think the 6 or 7 is probably not, historically, that's been where we've been.
And I was on a panel a couple of weeks ago with a developer who is a very seasoned, experienced developer. And I love this comment because he's like, look, we can make money in a high interest rate environment, and we've done it. We did it in the 80s, and we can do it again. And so it comes back to this buy-sell gap and getting people accustomed to a higher interest rate environment. But by historical standards, it's not necessarily high. It's just higher than it has been in the last 15 years, when it's basically been free money, right?
Yeah.
But for a lot of people, Brent, they don't know any other way.
Well,
That's they're locked into these low payments, and had a fair amount of disposable income, and that that is going to change, and that's going to drive a lot of people's behaviors.
So another interesting, just a number to throw out at you. The GFC concluded sometime in 2009. So if you graduated college in 2009, you'd be in the roughly 37-year time. You'd be about 37 years old today, give or take, if I did my math right. The median age of the U.S. worker is like 41.8. And if anyone's curious about where these came from, I can get you that information. But so to me, that tells me almost half of our workforce has really never seen a severe economic downturn. Of course, we had the brief blip with the pandemic. So Frank, I totally agree with you. A lot of people don't know any other way. And so it's going to be a long, kind of slow learning curve. Real estate has generally been slow to adapt to technology. However, we find ourselves in this new era where artificial intelligence has had a profound impact on real estate, particularly with data centers. So just maybe a brief comment, Jonathan, we'll start with you on where you see the impact of AI in your sector, if any.
Well, yeah, we're not, typically been investing in office, but I do see that because of AI, some areas of San Francisco office buildings may kind of get bailed out a bit just because of data centers, repurposing these office buildings for, data centers. So, yeah, I do think that there is an opportunity, definitely in like the San Francisco area, to get benefits of that. But I think the one thing relating to AI and data centers is power is such an important piece to that pie, that equation. So, making sure, I know some groups investing in data centers, and having available electricity servicing those buildings is paramount. And so, I know people looking, and that's like the first thing they're looking for is how much power is there, how much power can get there, because without the power, you're not going to be able to run the data centers.
And water too. You need the water to help cool a lot of the space as well as the components. Frank, thoughts on not only like opportunities on AI, but how it's also impacting your day-to-day business too.
I don't know that, I think what it can do is it can allow for some better data analysis, better collection of data on the underlying property. So I think there's benefits there that we're starting to really look at, but haven't really invested a lot of time in this yet.
Yep. Makes sense. Eric?
Yeah. I mean, the biggest impact is my analysts are doing a lot more work trying to figure out how we can better use AI. That's how it's different.
Right.
Because
We're the same kid. Yeah.
We haven't figured it out. And I think there's a lot of opportunity out there we talked about data analytics and all of this, right? There's how much of our business can we replace with computers? And I don't have an answer. It took us until about 2017 to get Netflix in your hotel rooms. So I don't expect there's going to be a whole lot of technological advances this year for us. But, honestly, we're looking at it. I just immediately not a ton of impact to our business day to day.
So stay tuned, right? I guess is the story. Yeah, stay tuned. It certainly will have an impact. And with that, I'd like to thank Jonathan, Frank, and Eric for your time, your views and insights, super helpful. And thank you all for attending. And with that, we'll conclude our webinar for this year. Thanks, everyone.